On Friday, Senator Angela Alsobrooks sat down with CoinDesk and said 7 words that should have sent shockwaves through every crypto portfolio in America. I will not vote for the Clarity Act. At that exact same moment, JP Morgan, Citi, Bank of America, and Wells Fargo were quietly finalizing a tokenized deposit network set to launch in 2027 that runs on the same blockchain rails the Clarity Act is supposed to regulate. Think about that for a second. The largest banks on planet Earth are building the infrastructure right now, while the people in Washington are still arguing about whether to write the rulebook. Jamie Dimon, the same man who called Bitcoin a fraud, went on Fox Business this week and admitted, "We do blockchain, we have connectors, we're going to do it." So why is a Democratic senator threatening to torpedo the most important crypto bill in American history? Why is the most powerful banker in the world suddenly fighting tooth and nail against a bill he claims he doesn't care about? And why is Senator Lummis warning that if this doesn't pass by August, we might not see it again until 2030? Here's what nobody is telling you. These 3 events are not separate. They are the same event. And once you see the pattern, you'll understand why the next 60 days are the most important window in the history of digital asset regulation, and why the smart money has already positioned for what comes after. Let me pull back the curtain. Today we decode the Clarity Act endgame, the negotiations, the names, the math, and the hidden incentive structure that explains why this fight looks the way it does. Before we go under the surface, this is analysis, not financial advice. In this briefing, we examine why a bill that should have passed 3 weeks ago is suddenly the most contested piece of legislation on Capitol Hill. Let's start with the hard truth. 90% of retail crypto investors are staring at price charts, wondering why their portfolios aren't moving. They're watching the noise. They're missing the signal. And the signal is this. The United States Senate is currently negotiating the framework that will determine which digital assets become part of the global financial system for the next 50 years, and which ones get regulated out of existence. Here's the structure most people don't understand. The Clarity Act is actually 2 bills stitched together. One half came out of the Senate Banking Committee, the SEC side, and it passed with bipartisan Democratic support after months of good faith negotiation. The other half came out of the Senate Agriculture Committee, the CFTC side, and it passed back in January on a pure 12-11 party line vote. Every Republican yes, every Democrat no. That January vote is the ghost in the machine. It means the agricultural half of the bill was never properly negotiated across the aisle. And now, in June, that unfinished business is coming back to haunt the entire process. Senator Alsobrooks is not bluffing. She listed 3 specific blockers: ethics provisions, illicit finance language led by Senator Cortez Masto, and the unresolved Agricultural Committee text. Each one of those is a legitimate negotiation point. Together, they're a trifecta that can kill the bill if mishandled. But here's where it gets interesting. She also said, and this is the part the headlines buried, "I think we can do it." That is not the language of obstruction. That is the language of leverage. To understand why this fight has suddenly turned vicious, we must first understand what has changed in the banking sector over the last 90 days. You see, retail investors think the banks have been fighting crypto for a decade. That's the surface story. But financial institutions, they don't fight technology forever. They fight it just long enough to build their own version. And then they pivot overnight and use their regulatory relationships to suffocate the original competition. That pivot just happened. Last week, the Clearing House, the consortium owned by JP Morgan, Citi, Bank of America, Wells Fargo, and 20 other major banks, announced a tokenized deposit network launching in 2027, 24/7 settlement. Blockchain-based, cross-border capable. This is not theoretical. This is funded, staffed, and being built. Now ask yourself the brutal question. Why is Jamie Dimon spending hundreds of millions of dollars lobbying Washington against the Clarity Act if he believes, as he claims, that stablecoins are a fad that will blow up on its own? He's not spending that money because he's worried about stablecoins. He's spending it because he needs 18 more months. 18 months to finish building the clearinghouse network. 18 months to lock in tokenization standards that favor bank-issued instruments over non-bank stablecoins. 18 months to ensure that when American consumers finally get tokenized money, it comes from a bank, not from Coinbase, not from Circle, not from Ripple, not from any of the native crypto players. Congressman French Hill confirmed this dynamic on Fox Business this week. He said directly, "The banks will be extremely competitive in this industry. I just don't have any doubt about that. That's not a hypothetical. That's a statement of intent from the chair of the House Financial Services Committee, telling you who the long-term winner is supposed to be." The Clarity Act in its current form threatens that timeline, because if non-bank issuers get regulatory clarity before the clearinghouse network goes live, the banks lose their head start. And in a winner-take-most market for tokenized payments, 18 months of head start is the entire game. Let's do the math that the retail crowd ignores. Global cross-border payments move roughly $150 trillion per year. The daily foreign exchange market clears about $7.50 trillion. Sitting underneath that is approximately $27 trillion locked in Nostro Vostro accounts. The pre-funded reserves banks have to maintain at correspondent institutions just to keep international payments flowing. That $27 trillion is dead capital. It earns nothing. It does nothing. It just sits there waiting to be moved. And it exists only because the legacy banking rails cannot settle in real time. Tokenized deposits and regulated stablecoins eliminate the need for that $27 trillion to sit idle. Whoever controls the dominant settlement rail captures fees on the velocity of every dollar that moves through it. We're not talking about a niche product. We're talking about the plumbing for the next generation of global finance. Now here's the part the banks understand, and retail doesn't. The Clarity Act is not just a crypto bill. It is the legal framework that decides who gets to operate that plumbing. Bank-issued tokens, non-bank stablecoins, decentralized networks. Each one has a different lane in the bill, and each lane has a different competitive advantage. That's why Senator Lummis went on the record this week, saying we need to wrap the Banking Committee bill, the Ag Committee bill, the ethics provisions, and changes to the Genius Act, all into a single package, and then get 60 votes for cloture. That's not a small ask. That's the legislative equivalent of threading 4 needles simultaneously while running on a treadmill. And it has to happen before the August recess. Because if it doesn't pass before August, the midterm calendar takes over. And if the House flips in November, this bill is dead until 2030. This isn't a prediction. It's a procedural reality. The window is roughly 60 days. After that, the math gets ugly. While retail investors are panic selling because of a bad CoinDesk headline, the institutional signal has never been stronger. Look at the evidence. The clearinghouse network, backed by the 4 largest U.S. banks, is being built right now for 2027 launch. That is a multi-billion-dollar infrastructure commitment. Does a consortium of trillion-dollar institutions move at that scale without absolute confidence that regulatory clarity is coming? Absolutely not. They don't gamble, they position. White House crypto advisor Patrick Witt called the Clarity Act a pro-regulatory, pro-enforcement bill. That language is not accidental. That is the executive branch signaling to the institutional investor class that the framework being built is one they can deploy capital into. Senator Lummis publicly stated that smaller community banks and credit unions stand to benefit because tokenization expands their service offerings. She also pointed to the data showing that as stablecoins have grown, bank deposits have also grown, meaning the two systems are not zero-sum competitors. That's a deliberate message aimed at peeling moderate Republicans and Democrats away from the J.P. Morgan lobbying push. And on the Ripple side specifically, XRP holders, pay attention here. The regulatory architecture being built around the Clarity Act is precisely the framework that allows institutional custodians to deploy at scale. The acquisitions, the licensing, the partnerships with payment networks, none of that activity makes sense without an assumed legal endpoint that looks a lot like what the Clarity Act delivers. This isn't retail FOMO. This is calculated positioning by market makers, custodians, and sovereign-grade institutions who can read a bill markup and know exactly which lanes they're going to drive in. If you're following this analysis and finding value in the breakdown, drop a comment below with the word clarity, so I know you made it this far. It tells the algorithm this content matters, and it tells me you're paying attention to the signal while everyone else is staring at the noise. Now let's get specific about dates, because vague timelines are useless. The White House wants the Clarity Act signed before the July 4th recess. That is highly unlikely. Senator Lummis herself admitted yesterday that the more realistic target is before the August recess, which begins the first week of August. That gives us a hard legislative window of roughly 8 working weeks. Inside that window, 3 specific things have to happen. First, the Agricultural Committee text needs to be renegotiated, with at least some Democratic buy-in, because passing it again on party lines will not survive a Senate floor vote requiring 60 for cloture. Second, the ethics provisions Senator Brooks is demanding need to be drafted in a form that Republicans can accept without revolting. Third, the illicit finance language Senator Cortez Masto has been pushing needs to be finalized in a way that satisfies law enforcement without creating compliance burdens that kill the industry. 3 needles, 8 weeks, 1 shot, and here is the catalyst that nobody is pricing in. The moment cloture is invoked on this bill, the moment the 60-vote threshold is crossed, the risk premium that has suppressed digital asset valuations for years vanishes overnight. Every institutional allocator who has been waiting for regulatory clarity before deploying capital loses their excuse. The wait-and-see money becomes the all-in money. Not in 6 months. Not next quarter. The day the bill clears procedural hurdles. When that switch flips, the current price environment becomes a memory. We are moving from an era of regulatory ambiguity to an era of regulatory resolution. And that transition only happens once. Right now, digital assets trade at what I'll call a regulatory discount. The market prices in the possibility that bad regulation could kneecap the industry. That discount is real, it's measurable, and it disappears the moment good regulation passes. There is no second chance to buy into the pre-clarity discount. Once clarity arrives, the discount is gone forever. And here is the structural reality. Once regulated institutional custodians begin onboarding digital assets at scale, which is precisely what the Clarity Act enables, supply moves from retail accessible exchanges into institutional cold storage. Those tokens do not come back to market for a 10% profit. They get locked into multi-year treasury strategies, ETF baskets, and balance sheet allocations. They are gone. The institutions have spent years watching retail panic in and out of positions. They've waited patiently for the regulatory framework that allows them to deploy hundreds of billions of dollars in compliant, custody-grade infrastructure. The Clarity Act is that framework. If it passes this summer, the door to pre-clarity accumulation closes within weeks. If it doesn't pass, and we end up waiting until 2030, the door stays open longer. But the entire competitive landscape shifts in favor of the bank-issued tokens being built right now by the clearinghouse consortium. Either way, the current window is unique. It does not repeat. I know it's tough to watch the market churn while Washington argues. I know the headlines feel like noise. I know it's easier to assume the bill will fail than to position for it passing. But as an analyst, I'm trained to distinguish between noise and signal. The noise is Jamie Dimon's lobbying budget. The noise is Senator Alsobrook's headline-grabbing quote. The noise is the daily price action. The signal is this. The largest banks on Earth are building tokenization infrastructure on a 2027 timeline. The Senate is doing the procedural work, however messy, to deliver a bill before August. The White House is publicly endorsing the framework. And the institutional acquisition and licensing activity in the regulated digital asset space has not slowed for a single quarter, regardless of price. While the masses focus on the daily drama, the smart money is finalizing positions ahead of a regulatory inflection point that mathematically must arrive, either this summer or after a delay that fundamentally restructures who wins the next decade. Being early feels exactly like being wrong, right up until the moment reality catches up. The question isn't whether the Clarity Act eventually passes in some form. The question is who is still holding regulated digital assets when it does. Here is the brutal truth nobody on cable news will tell you. The Clarity Act fight is not really about ethics provisions. It is not really about illicit finance language. It is not really about the Agricultural Committee. Those are the visible negotiations. The invisible negotiation is about which financial institutions get to own the next generation of payment rails and how much head start the legacy banks get before the non-bank challengers receive their legal green light. That is why Jamie Dimon is spending hundreds of millions to delay. That is why Senator Alsobrooks has leverage she's not afraid to use. That is why Senator Lummis is racing the August recess, and that is why the next 60 days matter more than the previous 6 years of crypto regulation combined. Price is a distraction. Structure is the reality. One is a headline, the other is the foundation of the next financial system. History does not reward those who waited for the news to be obvious. It rewards those who paid attention when the room was loud, the signal was buried, and the institutions were quietly positioning. Stay patient, stay rational. The math doesn't lie, and the framework is almost complete.